You're welcome to today's episode of The Human Angle. Happy Friday. As a matter of fact and obligation, every individual, whether resident or non-resident in Nigeria, persons in paid employment or businesses, or persons who derive their income from Nigeria, as well as companies that operate in Nigeria, are all liable to pay tax. Now, the failure to deduct and remit tax or failure to pay taxes of any kind, as the case may be, attracts disciplinary fines and penalties. Unlike other countries, the main function of the Nigerian tax system is to generate revenue for the running of the government at all levels and provide infrastructure to the public. Over the years, various tax laws in Nigeria have made provision for different taxes, one of which is the sales tax. Therefore, in today's episode, we'll be looking at an overview of sales tax as it relates to you and I as individuals. So first, what's sales tax? Sales tax is exactly what it sounds like, a tax on each sale made. It is chargeable on any product purchased at a retail store or online, and a retailer is responsible for adding the sales tax to the receipt, charging it to the customer, and then passing it over to the government as appropriate. So for example, if a product is made for 500 naira and is being sold at 1,000 naira, but at the place where you live, the sales tax rate is 10%, you actually need to be charged 1,100 naira. The extra 100 naira is marked as tax on the receipt, so you are aware that the money does not go to the retailer and is passed on to the government. In January this year, President Muhammadu Buhari signed the Finance Bill 2019, now Finance Act 2020, into law, seeking to promote fiscal equity, align local laws with global best practices, introduce tax incentives for investment in infrastructure and the capital market, as well as support small businesses in line with the ongoing ease of doing business reforms. However, more importantly, it was targeted at raising additional revenue for the government through the introduction of new fiscal measures, including the increase of the value-added tax rate from 5% to 7.5%. Now, VAT was introduced in Nigeria with the enactment of VAT Act No. 102 of 1993, which replaced the sales tax, and it has been in operation since 1986 by virtue of the Federal Government Decree No. 7 of 1986. And since its introduction, the Nigerian VAT rate remained unchanged at 5%, which was one of the lowest rates in the world, as other countries like Kenya, South Africa, Ghana, Austria, and United Kingdom had VAT rate ranging from 10% to 20%. Now, there were several attempts to increase the VAT rate in the past, especially in 2007 under the government of President Obasanjo, that increased the rate to 10%, but it was later reversed by the then incoming government of President Taiwo Adeoti due to the first opposition by many Nigerians. Now, VAT is a consumption tax, and it is administered by the Federal Inland Revenue Service, that is the FIRS, and is imposed on non-exempt supplies of goods and services within Nigeria, as well as on goods imported. Export goods are non-taxable. Therefore, transactions on basic food items produced within the country, books, educational materials, plants and machinery for use in export-free zone, agricultural equipment, and all medical and pharmaceutical products and services, amongst others, are exempt from the value-added tax. Now, all taxable persons, including non-resident companies carrying out business transactions in Nigeria, are required to register for VAT at the earliest of 6 months after the commencement of the VAT Act or commencement of their business, and then render adequate returns on or before the 21st day of the month after the month into which the transaction took place. Now, the VAT Act differentiates between two kinds of VAT, the input VAT and then the output VAT. To put it simply, the input VAT is a tax paid to suppliers on the purchase of taxable goods and services, while the output VAT is a tax received from customers on the value of taxable goods and services sold or rendered. Now, the VAT Act allows taxpayers to offset their input VAT, that is the allowable input VAT, against their output VAT to the extent that such input VAT only relates to goods that are purchased or imported for resale or form the taxpayer's stock in trade used for the production of new products, on which output VAT will be charged. And then other input VAT paid on overheads, service and general administration of businesses are expensed in the income statement as a deduction against the taxable profits, and those relating to capital expenditure are capitalized with the cost of the capital item. Now, where the output VAT exceeds the recoverable input VAT, the taxpayer is expected to remit the excess of this to the Federal Inland Revenue Service, and then in the instance where the input VAT exceeds the output VAT, the taxpayer will be entitled to a refund of the excess after following the due process as contained in the FIRS Establishment Act. Now, there are many SMEs that do not consider the VAT when doing their cost analysis, so they usually get shocked when the accountant calculates how much they are meant to remit for VAT. So if you don't know, this is the time to sit down. If you're an SME or you're a small business owner, sit down with an expert and evaluate your pricing, please, or rather do it yourself easily. But first, you need to decide how you want your pricing to work. Do you want it inclusive of your goods and services prices or exclusive? Meaning that if you see a bottle for 100 naira, inclusive means your actual money is 92.5, while 7.5 naira goes to the local tax office, or your price will remain at 100 naira, but your customers will then have to pay 107.5 naira. Secondly, you need to develop the habit of record keeping. Now, as a business owner or executive, you must always have records of your numbers. Regardless of your business, it's important you do so, but it's understandable if you really don't have the time to do that. So you can make use of available tools and apps to just record your expenses and sales, and then as you grow bigger, the need to either outsource the accounting or hire an in-house accountant will come up. But because you have your historical record already, it will be easy for the accountant to make the analysis. Now, meanwhile, you will be able to show this person and the tax person when they come in that your monthly sales are just 10,000 or 6,000 naira or whatever amount is there. Now, thirdly, you need to file and remit it monthly. VAT remittances are monthly. Therefore, do not make the mistake at all of wanting to remit quarterly or even in a year. It can be tempting, but you actually spend the money and it's not even yours to start with. So every month, once you have determined the actual sales that you made, deduct the 7.5% and pay. And then lastly, you need to be able to defend your numbers. Now, tax remittances can be funny and it greatly deals with trust actually. So when you claim that you've made only 7,000 naira in sales for 1 month, but your inflow in the bank account is showing 70,000 naira, it can be very tricky. But you need to be able to defend the extra 63,000 naira when asked by the tax forces or even your accountant. Now, as an SME, know that it's an offense to collect VAT and not remit accordingly. Therefore, please ensure to comply and remit appropriately, and even for individuals like you and I also. And that'll be all for this edition of the Human Angle. If you have questions or comments, can you send a mail to programs@proshareng.com and business@proshareng.com. And news stories and videos. Also follow us on our social media platforms showing on the screen for further updates on our market reports. Till I come your way again next week, thank you for watching and bye for now.